Hi friends, this is Dr. VINAYAK PAGEDAR and we meet once again. Today I will be discussing a critical part of the chapter of income from house property, and that is the element of pre-construction interest. Many students contacted me and said that, sir, could you please put a video on pre-construction interest? Somehow we get jumbled and confused when we do that calculation. So for them and for all of you who are watching, this video is the most simplified way in which you can calculate and accurately get the pre-construction calculation and the interest on loan deduction. I hope that we meet in the best of times. Wherever you are safe and sound and healthy, and we'll move ahead. A small request to you is you should go through the video properly. If you have any queries, feel free to revert, and also do not forget to hit the subscribe and the like button if you like the video. Correct? If you do that, it keeps me motivated enough to post more and more such snippets which would add to your knowledge and to your success. So without further ado, let us start discussing the concept of pre-construction interest. First of all, what do you mean by the word pre? The word pre means before, and as you know, pre-construction interest is interest before the completion of construction. Correct? Now, this pre-construction interest is also sometimes called as pre-acquisition interest. Take for example, today I go to purchase a flat from a real estate developer, that is a builder. The building is yet under construction and the flat will be ready 3 years down the line. I take a loan and I purchase a flat under construction, and the flat will be handed over to me 3 years down the line. In such cases, the pre-construction interest could also be called as a pre-acquisition interest. The second case is, if I purchase a plot of land and start constructing a house, I take a loan for the purpose of construction, then whatever interest I incur during the construction stage of the house is the pre-construction interest. Now let us go further into the chapter. Number one, it is the interest which is related to the pre-period, and it definitely means that the pre-period, what exactly is the pre-period? If you look at the definition of pre-construction interest, it says it means interest arising from the date of loan and ending on 31st March immediately preceding the completion of construction. In short, my dear friends, pre-construction interest is nothing but interest before the year of completion of construction, not before the date of completion. It is interest before the year of completion of construction, and that is pre-construction interest. Now, once you have calculated the pre-construction interest, you have to allow it as a deduction. You can claim the deduction over a period of 5 years. That is, in 5 equal installments starting from the year in which the construction is completed. Correct? Now, this is the theoretical part of it. We'll just complete a bit more of the theory, and then I'll explain the entire logic to you with the help of a couple of very simple illustrations. So, my friends, understand, the current year's interest and 1/5 of the pre-construction interest can be claimed as deduction. If your house is a let out property or a deemed to be let out property, LOP or DLOP, you get a full deduction of the total interest. However, if your house is a self-occupied property for residence, which we call as SOP, SOPR, then How do you calculate the deduction? You take the current P-wise interest. To this you add 1/5 of the total pre-construction interest. Why 1/5? Because it's available as a deduction spread over a period of 5 years. So 1/5 of the total pre-construction interest you add to the current year's interest, and that total is called as the total actual interest. Now, if the house is self-occupied, as in the case it is, you have to compare this with the maximum limit, and the maximum limit would be 30,000 or 2 lakhs, whichever is lower. Correct? So, take the total actual interest, compare it with the maximum limit. It could be 30,000 in case the construction does not get completed in 5 years, etc. Then in that case, the maximum limit for SOPR is 30,000. In any other case of purchase or construction, it would be rupees 2 lakhs, and this we have dealt with separately. So you take the total actual interest, compare it with the maximum limit, and whatever is lower will be your deduction. I hope this is clear. Okay. Now, my friends, let us take a very simple example. A loan is taken for construction. In this example, we are assuming that the loan is taken for construction, and the current P-wise interest, that is 2019-20, the current P-wise interest is rupees 1,50,000. Furthermore, the total pre-construction interest comes to 3 lakhs. What will be the interest on loan deduction which you can claim under section 24B for the PY 1920? So let us compute the interest on loan deduction. Very, very simple. Now, we take the current PY's interest, 1,50,000. We locate the total pre-construction interest, which is 3 lakhs. 1/5 of the total pre-construction interest, that is 1/5 of 3 lakhs, will come to 60,000. So 1,50,000 plus 60, the total actual interest will be 2,10,000. Now my friends, we have one of your colleagues here, one of the students, this Maushi, Chechi, whatever you would like to call her, and this kid has a doubt. She says, what if the house is a let out property or a deemed to be let out property and the total actual interest comes to 2,10,000? She wants to know the interest on loan deduction. We calculated the total at 2,10,000, but she says, what if the house is a let out property or a deemed to be let out property? You are her tax consultant, her chartered accountant, she is your client, and now you have to give the answer. As we discussed in the earlier slide, we had shown that in case of LOP or DLOP, the full deduction is allowed. There's no restriction on the interest deduction, and hence the full deduction will mean the entire 2,10,000 can be claimed as deduction. But then our friend here would come back with another doubt, and now she says, what if this house, this house where the interest has come 2,10,000, what if this house is SOPR, a self-occupied property for residence? Then what? Then the answer is, in absence of any further information, I assume that all the conditions laid down are satisfied. What would be the conditions? The house is purchased or constructed on or after 1/4/99. The loan has been taken on or after 1/4/99, and the construction has been completed within a period of 5 years from the end of the financial year in which the loan is taken. Now, if all these conditions are satisfied, we assume so, the maximum deduction would be 2 lakh rupees. So now the actual interest is 2,10,000, But since this house is self-occupied, the maximum limit is 2 lakhs, and therefore in this case we cannot get a deduction of more than 2 lakhs. I believe these basics are very clear, and this is the simplest form of question which can be asked in the exam. Now we'll go to another question which involves a bit of calculation, and I will be telling you how to approach the question and the flow to be followed in the exam. What happens, my friends, is in the exam, if you are not systematic in solving the paper, many a times it starts panic, and because you press the panic button, the other solutions also go wrong. So if you got a planned method, a planned approach, then you will never ever go wrong. So let's see the question. Okay, it says loan was taken for construction on 1st October 2015. Rupees 10 lakhs was the loan. Rate of interest was 12% per annum, and a loan of rupees 4 lakhs was repaid on 1st April 2019. So we've got a loan taken for construction on 1st October 2015. The moment you see a date, please identify the PY to which it relates. The previous year to which it relates is 15-16. So in the year 15-16, a loan was taken 10 lakhs at the rate of 12% per annum. The repayment of 4 lakhs took place during the current year, that is during the year 1920. And remember, most important, the construction was completed on 31st March 2018. Again, wherever you see a date, please try to identify the year. Yes, you are right. The year of completion is 1718. Correct? And we need to calculate the interest on loan deduction for the year 1920, which we will post under section 24B in the statement of income from house property. So let us start, my friends. We prepare a table for computation of interest on loan deduction. Now if you observe, I've got 3 columns: particulars, the PY to which these particulars would relate, and mainly the most important thing is the interest. The question says compute the interest on loan deduction, so I am mainly interested in the interest. If you observe, if this is my entire page, your screen is my entire page, you must observe, you've observed probably that there's some space left to the right. Correct? So remember, you should always leave some space to the right because we have to do some sort of workings here. You'll come to know slowly but surely. Okay. Now the first thing to do is start with the first year, that is 15-16. Let us calculate the interest. Now loan of 10 lakhs was taken, 12% per annum. So that would be 1,20,000. But since you took the loan on 1st October, that is in the middle of the year, your loan was outstanding only for a period of 6 months. So the interest liability will only be for a period of 6 months, and therefore your interest will be 10 lakhs into 12%, 1,20,000 into 6 divided by 12, which comes to 60,000. Correct? The moment you've calculated the first year's interest, I would advise you to finish off all the year's interest for all the future years without looking at the construction completed at this moment. At this moment, forget the completion of construction, and in a flow, in a smooth, rapid, quick flow, let us finish the interest for all the further years up to 1920. In 16-17, there was no further repayment. 17-18, there was no further repayment. 18-19, don't think of construction completed at this point of time, please. 18-19, there was no repayment. But yes, in 1920, on 1st April 2019, there was a repayment. Correct? So, Can you tell me what will be my interest for 16-17? 10 lakhs. And in 16-17, the loan was outstanding throughout the year. So 10 lakhs into 12% per annum will give you 1,20,000. 17-18, I do not see any repayment. 1,20,000. 18-19, there is no repayment. 1,20,000. But in 19-20, my friends, there is a repayment. In this question, we have very clearly mentioned the repayment takes place on 1st April. If the question is silent on the date of repayment, you assume that the repayment takes place on the first day of the year and write a note to that effect. The original outstanding amount, the loan outstanding till this date, was 10 lakhs, and on 1st of April you repaid 4 lakhs. So your outstanding loan now is how much? It is 6 lakhs. And 6 lakhs at the rate of 12% per annum will give you 72,000. As of now, let me once again take you through the journey so far. So what did we do? First, we calculated the interest of the first year. The loan was taken in the middle of the year, so the interest was 60,000. Then for every future year till the current year 19-20, what we did is we kept on calculating the interest. Yes, we kept a watch on loan repaid, because if there's a repayment, that would change the interest amount. So my friends, the loan was repaid on 1st April 2019. Out of 10 lakhs, 4 lakhs got repaid. So 6 lakhs was the outstanding loan. At 12% gives you 72,000 as interest. Correct? At this point, you should look for the year of completion, not the date of completion, but the year of completion. What is the year of completion? The year of completion, my friends, here is 17-18. And so, bang opposite 17-18, in the particulars column, I mention construction completed. In my initial discussion of the theory, we discussed that pre-construction interest is not interest before the date of completion, it is interest before the year of completion. So, what would be the total pre-construction interest? Pre means before the year of completion, so I draw a line. As you see, the dotted line separates the pre and separates the post period. The dotted line separates the pre. Pre means before the year of completion. So now I take a total of the pre-interest. Can you tell me what will the total be? Correct? It is 1,80,000. This 1,80,000 will be allowed as deduction over a period of 5 years. That means per year, how much can you claim out of 1,80,000? That is 36,000. Try and understand why we have to do this. If I had purchased a house, a ready house in 15-16, the basis of charge would have been attracted. Section 22 says that there should be a house property and the assessee is the owner, so the basis of charge gets attracted. If you purchase a house property which is ready, there itself the basis of charge gets attracted, the statement is prepared, and in every year, in 15-16, say for example, you could have claimed your 60,000, in 16-17 you could have claimed the 1,20,000. But my dear friends, if the house is not completed during the under construction stage, the house is incomplete, it is not complete, and hence section 22 fails. It says there should be a house property, there is no house property. Purchasers would get the deduction immediately, people into construction would not get the deduction because their house is not ready. So those who are constructing a house property, the pre-interest is accumulated, and it is allowed to them over a suitable period of 5 years starting from the year in which construction is completed. I hope you have understood this part. A purchaser who buys a ready house can get the deduction in the same year itself. So a purchaser would have got the deduction in 15-16 as well as 16-17. But those who are buying a house under construction or constructing a house, for them the section 22 charge fails. There's no house property, so no statement got prepared, and so they could not claim the deduction. So should they get the deduction or not? The answer is yes. From when? From the year in which construction is completed. When did the construction get complete? The answer is 17-18. So 1, 2, 3, 4, 5. The 1,80,000 spread over 5 years starting from 17-18. So my friends, in 17-18, your deduction will be 1,20,000 plus 36,000. In the statement of house property in 18-19, again 1,20,000 plus 36,000. But for our exam, we'll be getting the question on PY 19-20. So we are interested in the interest related to PY 19-20. And then I've just, for understanding purpose, made sure that you understand how the apportionment takes place over 5 years. Now, as I told you, we are interested in the year 1920. So in our statement of income from house property, the total deduction for 1920 will be 72,000 current PY's interest plus 1/5 of the pre, that is 36,000, which is 1,08,000. Now here, I believe so far so good, you've understood things. I have a query, and my query is, you observe the solution. Let us say the house was completed on 1st of October 2017, exactly in the middle of the year. Then out of that 1,20,000 interest of 17-18, how much would be pre and how much would be post? And those who are thinking 60,000 pre and 60,000 post are wrong. My friends, once again, we do not lay focus on the date of completion. We are interested in the year of completion. And remember, very simple, year of completion is post, prior to that year is pre. Pre-construction interest is not interest before the date of completion. It is interest before the year of completion. So, it does not matter whether the house is completed on 1st of April, 1st of October or 31st of March. The year of completion, the basis of charge gets subtracted, the statement gets prepared, and so the entire interest can be claimed as deduction. I hope you have understood. If you have any queries, I've given my number, my mail, you can post it to me and I'll be more than happy to solve them. Till then, so long, be good and all the best.